All right, so some trade headlines over the weekend got us off to a pretty volatile start to the week. We were expecting some volatility, we were expecting some weakness. We got a lot of it right, in over a weekend. So, and we got so much so fast that actually led to a really good buy the dip opportunity, as I suggested last night on Twitter for those that follow me there. So now what do we expect? I'm gonna break that down in today's video to see what kind of pullback we should get now that this was so crazy of a move today, and then how to trade stocks that actually were one stock in particular that's actually showed a lot of volatility before we even got to this weekend, and may actually now start to calm down a little bit along with the rest of the market. So let's go ahead and get started. Today is Monday, May the 6th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 here first with the market forecast indicator. Of course, we started off the day very, very low, down here closer to 2,900, so almost right on the 30-day moving average before rallying and finishing the day, 34 points off of the low in a 39-point range, so pretty decent. That's why your near-term line bounced, right? The momentum line came down as we dropped from Friday's close, but the near-term line continued to rally because we rallied off the lows. That's, like I said, finishing 34 points off the low in a 39-point range is a pretty decent move for the S&P, especially considering how we began futures trading last night. We're still in this range here. Now, granted, in the overnight trading already we're down, so we'll see. Like last night, the overnight trading the volume is so low that you really can't trust anything until the regular market opens, and that's when all the volume kicks in, right? And we get the moves that we can, especially at the end of the day, that we put more importance on. The intermediate line and the market sentiment line are both still above 80, so they both still reflect a strong posture regardless of this volatility that we've had today. The momentum, like I said, down, but not to an extreme low point again like we had over here, and the near-term line still up. Now, that near-term line, where it peaks, is very important because it's already above 50, and you need it to get above 80, and you need it to stay above 50 for 7 to 12 days, probably right around 7 because of how bullish we've been. If we don't get up there above 80 and we turn down below 50 after, say, 2 or 3 days, then that's another red flag, especially considering that we didn't get up to a new near-term high point. We didn't break up to a new higher near-term high. So we'll keep our eyes out on that for the next day or two, or especially here tomorrow with how we've started off so far tonight. But as of right now, nothing has changed this strong bullish trend that we've had on the S&P. In fact, the small cap index actually outperformed and actually finished up above. It kind of held that breakout from Friday and finished at 1498, and we were at 1402 yesterday. So a little bit of a gain by the end of the day on the small cap index. At least on the cash index there, and definitely a long lower shadow. Near-term line did get above 80 because of that breakout move that held. Momentum line down, not surprising because of the low point that we made today, but still strong near-term line. Again, a lot of volatility, but nothing that reflects strong bearishness yet, right? And you can see the Nasdaq had an even bigger opening up at Thursday's low and then finishing up inside of Friday's range. Again, bringing that near-term line up in the upper reversal zone, which is what we want the S&P to get to, even with the momentum line dropping. In fact, actually came very, very close to producing an overbought cluster today. With all that, how we started, to finish the day with an overbought cluster would have been significant on the Nasdaq Composite. We didn't get up to a new high. We were down a little bit, but still very, very bullish close there for the Nasdaq. And then finally, we take a look at the Dow Jones Industrial Average. It actually opened up a lot lower than all these lows, so it actually kind of had the most bearish low point. In fact, it opened up below the 30-day moving average before bouncing up like everything else by the end of the day. Remember, everything is down so far in the after hours market. So, but you know, again, it's not how we trade in low volume markets. It's how we trade when the market's open. So we'll see. In fact, it's almost, you know, a lot of times you get your bullish days after you have pullbacks in the after hours, because that's where the low volume is, and you get good pricing. So when higher volume comes in, they can get in at those prices, and things go back up again. So we'll see how things open up tomorrow. But you know, some little bit of volatility, but nothing yet that would suggest that, oh no, you know, not only, I mean, we've been expecting an intermediate pullback. Not, you know, this bearish move that we've gotten hasn't shown to be that it would suggest that we'd get anything more than what we've already been expecting anyways. All right, before we look at some other charts here, reminder, subscribe to our YouTube channel. Click that red subscribe button that's down below the video, or you can mouse over our logo right here and then hit that red subscribe button that pops out. Click the thumbs up icon down below the video. That tells us two things. Number one, you got something out of the video today. Number two, you want us to do it again tomorrow. And also comment down below on anything that stood out to you. What did you get out of today's video? Join our daily market outlook email list. There's a link popping up there in the top right corner of your screen. Click on that link to subscribe to our list. Follow me on Twitter for more content like this in between videos, and join our market outlook community that we created on Facebook. All right, now let's take a look at the rest of these charts here, and we'll see the weekly chart filling in the long lower shadow from last week on SPX on the weekly candle. Now remember, so far at least. Now remember the Heikin Ashi. We talked about the high likelihood that we'd get a transition candle this week, and just like that, we did today, right? Because we moved so far down. So that's at where we're at right now. Now remember, the close on the Heikin Ashi is the average of the week's high, low, open, and close by the time we're all done. So obviously, we have a low point now, we have an open, which those two are pretty equal to each other. You take a look at over here, you can see the open and the low are pretty close to each other. The close and the high, that remains to be seen by the end of the week, right? And we might even test that low by the end of the week. So we'll see how things end up. But you can see how we're starting to get a transition candle already on that weekly chart. You take a look at the 3 green arrow chart, and you see we still got the 2 red arrows. We did not get the third, so we still haven't really even tested that 30-day moving average yet, at least on a closing basis, right? You look at the 2-line versions here. We did come down early at the open below the 17-day moving average before closing all the way back up above the 8-day moving average. Now remember, we're down in the after hours, but we'll see. You can kind of see how we're still maintaining this bullish trend. We typically, and I tweeted this out last night, and that we typically don't fall with big ranges with a lot of volume from all-time highs. We usually have the big abnormal ranges, and I'll show you that here in just a second, but usually they come at the end of bearish moves. So it was a nice, good pullback in the after hours that allowed us to have this kind of a bounce, again, all the way back up above. But you can see that the signs of weakness have been there. We've been expecting this a pullback. We continue to have the MACD and the stochastics below their moving average. They have red arrows on them, but they're still, like I said, above their midpoint. So we're not going to get an intermediate pullback today, no matter how bearish we were. In fact, the more bearish we were at the open, the better, because it makes it more likely that we'd bounce. So we're not going to get a bearish intermediate pullback tomorrow, no matter how bad it looks in the after hours here. It's a process. It doesn't occur in a day. I know it makes it nice and tidy if we can get all our selling over in a day, but that's not the reality of how things work. All right, now let's take a look at the intraday chart, and this is what I was talking about before. There's the Heikin Ashi open, so we gapped way down here, and then actually hit a low point of 288.90 before rallying up to 292.87. So a 4-point move off of the low point there, and that still didn't even fill in all the gap from overnight. So nice, good range, and the overnight range was actually a lot higher. And if you look at the, if I were to change this and show the extended hours trading, you can see that the extended hours low point was actually 287.95. So we ended up with, from from where we closed around 294 and a quarter, we had a pretty decent, over 6 point drop, and that's what I tweeted out late last night. I tweeted out right here that the range was at 6.5 points. We were obviously overnight trading very, very low volume. And I know that buy the dip gets thrown out on pretty much any down day we ever have, but really, when you have these big abnormal ranges, and when I say abnormal ranges, I'm talking about here, you can see, like I said, today's range on SPY, remember, was only 4.5, but remember in the after hours, you had a couple more points to the downside. So you actually had about a 6.5 point range today, and you can see the volume, and just in the regular trading, was over 1.5 times the average volume. So that the volume didn't get to an extreme by the end of the day. If we had finished up here in the 200 million, then we would have had an extreme. 100 million, not so bad, but the 6.5 point range, that's really high. That comes out of nowhere, and again, the higher the range like that, the more extreme it is, the more likely that ends up being your buy the dip. And literally, from the time that I tweeted that out last night at 10:54 my time, you can see there's 10:54 on that candle, 10:55 right there. The market rallied almost immediately with some volume kind of kicking in. So that's kind of what I was like, okay, who's out there trading off of my tweets in real time? But that's kind of what I was talking about here is when you get the more extreme it is in the after hours, the better, really, it ends up being. And we've seen how many examples of that in the recent past. So the averages are still low, but they're rising. And what would be more bearish is if we were to have 4-point ranges, volume like we had today, 100 million, and it kind of stays in this 100 to 125 million, and we gradually pick up, and we have 4 to 6 point ranges that gradually picks up, so we don't get any extremes, because the extreme moves come when we get these kind of moves, right? These are the big crazy moves, and we get a few here and there, but those are the moves that we worry about coming at the end of all these ranges. 10-point move there, 7-point move there, 9 3/4 point move there. I mean, look, that's well off of this chart here. 12.5 point move there on the bounce, right? So those are the kind of moves that tend to happen at the end of a bearish move, the big abnormal ranges. Let's look at the volatility. And we talked about volatility jumping up towards this one area this month and getting a range up, getting a move up towards 18, 19, up to 20, so that the monthly range for volatility rises. Well, you can see the monthly range now is over 6 points. After only 3 1/3, we're back up to 6 points. And if we are to go, a little bit below, see the low point's only 1274. Go back to the regular chart. If we were to come down, towards 12, we'd get a little bit more of a range. If we were to go up towards 18, 19, which probably isn't as likely now, but if we were, we would have a little, that's kind of the range we were expecting to get because of how small the range was during the month of April. But we got our bump up to 1. How fast we come down here will tell us whether or not we get, whether this ends up being the intermediate pullback, which I venture to guess we're on our path. Again, it won't occur tomorrow, it won't occur by the end of the week. But I'm venturing to guess we're on our path towards our intermediate pullback now. That then, once we get back below this 90%, we're back on the bullish trend. Then we'll start trading in the lower half more of this bullish range, and we'll start to really trend higher after we get the kind of pullback that we want and kind of need to get to build a more solid base. You can see again, as low as we got, as bearish as things were last night, we still got another 100 points to go before we even just hit the 23% Fibonacci retracement, which is also happens to be around where that 40-week moving average is. So to summarize, and we got some weakness today, we got a little bit of volatility today, and it was so extreme that it was actually beneficial to us at the beginning of the day. And this may be the beginnings of the intermediate pullback. Intermediate pullbacks don't occur in a day or 2 or 3. And so whether or not this turns in, this is the beginnings of that pullback, which we've already seen clusters and extreme lows and momentum. So there's been plenty of red flags. So this process may have already started of the intermediate pullback that we're already on, but it's not going to end by the end of the week. right? It's going to be a process where we get a little bit more bearishness, a little bit more weakness, or at least at the least less bullishness, far less bullishness than what we've had. That will start bringing some of these indicators down, provide us with a better low point to start from again. So what do you think of that? Do you agree or disagree? Click that link popping out in the top right corner of your screen, then hit either agree or disagree there. If you click disagree, scroll to the bottom and let me know what you're seeing. That would suggest either why you're a lot more bearish than I am, or that maybe this is all the pullback that we're going to get. Let me know down in the comment section down below. All right, now let's break down what's driving price action today. And again, you can see the reflection, like this trade deal, what we had overnight. You can see how agricultural prices here over the last 2 weeks have been really bearish already. And this is your biggest reflection right now of the market sentiment towards any kind of trade issues with China. And we were already down 4% on agricultural commodities before today's drop to push it down even further, down 5%. Of course, emerging markets are the ones that suffer the most from this, and they're down. They were down big today, and you can see the stocks with the least exposure to any trade issues are small cap stocks, which actually finished at a 2-week high point today. So it's actually a really good sign to see small cap stocks outperforming. You do see long-term bonds rallied up a little bit here. The dollar was up. It's coming down from some recent highs, but it was up on the day today. In fact, if we just look at just today alone here, here we go. Look at a 10-minute chart. Then you can see how everything started off, and especially emerging markets, started off really bearish. Developed markets, agricultural commodities, everything rallied. And you can see crude oil rallied and finished up 1.5% today. And the dollar started the day strong, finished the day with a small gain. But everything else, look how flat things were on a relative basis considering the volatility of the day. So it kind of puts in context the move that probably a little bit more headline risk than actual risk than what we saw overnight. And I think that's how everything ended up playing out by the end of the day. Everything pretty much between 0.3% gain and 0.5% loss outside of international stocks, which is not surprising they would struggle, agricultural commodities, and of course on the other end of the spectrum, crude oil. You remember crude oil has been the one sign that's been so correlated, and it's been showing weakness already before equities. You can see today's long lower shadow, and bullish candle here. So it's a positive sign. The intermediate line did turn down here, or at least it's turned down today. That the new day has started here, and the intermediate line is below 50, showing a dark pink shading, but we don't have a dark red line. In fact, depending upon how we close today, we might actually be back up above the moving average and have a green line again. In fact, you can look at the 3 green arrow chart here for crude. You can see, we did get the 3 red arrows, and as of right now, getting 1 green arrow. Still got some room to go before we get the MACD. That's usually it's the first red arrow to occur, the last green arrow to occur on a 3 green arrow chart. But you're that much closer to getting a green arrow again on the moving average after pulling back to that 23% Fibonacci, the type of pullback we expect to see eventually, at least on the S&P 500. Now, of course, you can see here, look at the difference in how China responded. FXI, the ETF for FXI responded compared to how the S&P. So much bigger declines. You can see everybody dropped early, some more than others. India didn't get back above its moving average. UK, France got barely above it. Germany stayed above it. Italy down, like China, down below its lows. Korea also gapping down below it to a 3-month lows and closing there. So you can kind of see which ones held up better than others. But this was very, very focused on China and, of course, South Korea, very correlated there with what's going on in China and even Italy from a developed nation standpoint, kind of more the emerging market in that area out of all these major economies there. So put all of that in perspective compared to what we're seeing on the S&P, right? The S&P still has a intermediate line up above 88. Here, China's intermediate line's below 50, and it's falling. So you don't have that bearish combination, but more than likely you will on Monday. India's below 50 and falling, and Italy now below 50 and falling, and below its moving average there. South Korea below 50 and falling. Brazil is below 50, is rising, but it has been falling. So there's some markets that are already more bearish than what we're seeing here in the U.S. And again, there was for a long time in 2018 that there was a pretty steep divergence. A lot of these foreign countries on some trade issues were weak, while the U.S. maintained its bullishness. In this particular case, more than likely, any kind of weakness we see over here most likely will lead to the same type of pullbacks that we expect to see on the S&P as well. Interestingly, when you see what's been doing really well in the last couple of weeks is that healthcare sector, which has been so bearish. It broke up to new highs today. If I were just to look at the one-day chart here and just look at today, here we go, we'll go to a 10-minute chart. You can see healthcare ended up with a decent gain. Staples, energy, right around break-even. Remember, crude oil rallied. On the other end of the spectrum, materials were down, industrials were down. Those are dollar-sensitive areas. Technology down below the S&P 500. It's had some strong gains lately. Consumer discretionary also lagging behind, along with utilities. So some interest rate sensitive, some dollar sensitive areas, cyclical area, all lagging behind and bringing the S&P down. You can see the winners and losers over here on the left, and healthcare, which has been such a loser, why it's winning so much lately, because it's got some room to gain in terms of relative performance versus its peers. If you take a look at the 12 grid for these sectors, again, you can see here in a second. There we go. You can see how some of these got down closer to the moving average than others. Discretionary, technology, financials is still maintaining some strength. Staples are up there. You can see healthcare finally getting back above its moving average, whereas material and energy are still down below. In fact, energy still has that bearish combination of a bearish posture and a falling moving average there. So not everything is looking like the S&P, while some are, and even late today, some pulled back more than others, which is what you'd expect. This technology, discretionary, they've been so bullish. They've got double-digit gains still on a 3-month basis. We would expect that, in any intermediate pullback, they will fall down the most. Where some of these others that don't have such big returns, 5, 6, 7, 5.5, they're not going to fall back as much. Real estate hardly moved at all today, and the utility is still stuck in the sideways range, and that's not surprising. Considering they had such good performance for a long time, but they're already starting to moderate, and we're really getting some divergence of performance here, which another one of those red flags that this intermediate run is most likely ending soon here. All right, for our trade idea of the day, I want to take a look at a stock that has already shown a lot of volatility, as you can see here on the chart, 3M. Before the market itself. And of course, earnings announcement after a really strong bullish trend has brought it down basically to its 52-week lows. What's interesting about this chart, and of course, way down in the lower half of the Bollinger Bandwidth. The Bollinger Bandwidth is about as high as it's been, at least in the recent, right? So remember, this is a percentage basis, so you can compare this apples to apples. And the last time we were even closer at 28 right now. Last time we were even close to that was back over here. But the difference between August of 2011, the whole market was down, not just 3M. And another big difference is when you look at the volatility charts here for 3M, you can see that, and let's go back to that 2011 time frame. You can see that was another time where historical volatility, we're up to 50% historical volatility right now. That we were up there at this point too, but look how high implied volatility was up to here 0.4 versus 0.2178 where it's at right now. That's a really, really big gap, and it sets us up for the opportunity for 3M now just to not go anywhere, and to keep its risk small. And of course, with that support level kind of forming, sitting at the 52-week lows here, kind of a little bit of a of a triple bottom type of a pattern, and then with some room to go to the upside, with a lot of supply on the upside, because we fell down so fast and so hard. We've now got a lot of resistance here, even up until we get to the gap, where there's going to be some resistance there. So if I were to say, okay, well, let's take a look at setting up two vertical spreads here, a condor. I can sell the 180, 175. It's a little bit high in the delta, above 40, but it's right where that support is. So sell the 180, 175. The 195 is at the top end where the gap is, right? The top, right where the right above that 195 is where the gap is, and of course, right above that is where a big level of overhead resistance is. So a lot of resistance in that area. We got some support down in this area, and we've got extreme volatility here recently, but the implied volatility suggests that we're not going to get that much more of a move, or not to expect much of a move. Very different than what we saw last time we were this volatile, and of course not having the market be as volatile along with it. So that gives us the opportunity to say, okay, well, let's get a pretty decent credit here, and we get a good reward anywhere in that area. And remember, I'm willing to lose $218, which is actually most of the maximum loss. So I can give myself a lot of wiggle room on this trade because of the really good reward to risk ratio that we have. And as volatility declines and we kind of stall in this area, the goal is that that's how we profit from this trade. Alright, so that does us for today. As always, thank you very much for watching. Now I want to hear from you, so use that link popping out up there in the top right corner of your screen. Let's go to our Market Outlook forums on MarketScholars.com, open up any new thread, ask any questions or comment on anything you got out of today's video, or on anything I didn't discuss in today's video, but you wanted to get the conversation going among the Market Scholars community. So remember, you can also reply to anybody else's thread as well. That's the point of a forum. Again, thank you very much for watching. Have a great rest of your evening, everybody. We'll see you all next time.